Hello, this is the Chart Profit video. Heading towards 90 minutes into the trading day on Friday 21st of July. Looking here at the pre-open, this is the E-mini S&P 3-month controlling price down here at 2436.50. The last 7 value areas have been printed above that level, which is strong price location, and we've marked aggressive buying twice on the profile in the last 5 days. With the market heading higher, this is effective buying. Market up strong over the last few days. Middle of last week on the left here, I just extended the daily profile, the point of control for that day across to the right and the following day, which is the first very minor level of support that you can get the following day. We've seen this before. It's kind of an uptrend definition when the previous day controlling price gives you support in the following session. I'm saying the first minor day frame weakness would be 2456.50 if we see a value area printed below that 10-day controlling price, with the big support obviously at 2436.50 down here. Since late May, in here we've seen the breadth in the middle here of the pulse chart for New York either neutral or the bulk of the time positive. As mentioned last week, across this trading range at the top here, we had 3 instances of significant selling. Those are the red bars, and yet no real damage done. We stayed in this range, and then when the momentum picked up, trend went back on the daily time frame to positive at the point where it crossed through 0 here, and the pulse staying at least neutral and then turning positive at this point. We've had 2 aggressive buying days here, so the market, or the pulse chart, looking much healthier than it did just a few days ago in here at the end of June. I've mentioned in the pre-open that with the S&P higher, in fact breaking out to a new high in the last few days, the RIDEX, or my version of the RIDEX assets ratio, has been falling pretty rapidly. Indication that the retail investor is literally not buying this breakout. At that point of breakout, very skeptical. You can see the decline in the ratio, albeit having reached an all-time high at this point, which in the longer term is usually a warning for the market. But I did say this kind of pattern here, pretty bullish in the short term. The point where the ratio reached its peak at the start of the month, if we look at the bear fund assets in isolation at this point here, that's the lowest in the database. Just no bears at all in the data. That picked up, the assets picked up in the bear funds actually as the market climbed, which, as I say, is a kind of indication of short-term contrarian, if you like, strength. But just the fact that we saw that lowest point there in the whole database is just a little concerning. With bull fund assets falling as well across the same period from the start of July, you can see that the funds that I follow, the total assets have fallen to a multi-month low. It's worth noting that tops usually come in on the market chart with this indication, this total assets, usually pretty elevated. Lipper US fund flows reported equity fund, including ETF outflows this week, or the week to the 19th of July, of $2.6 billion. Not a huge outflow, but an outflow. And the 4-week flow is negative here. It's pretty much in line with the RIDEX data and an indication of what the retail investor is doing. This is what the retail investor is saying, certainly in this poll here, the public poll from AAII. The bulls percent this week was higher, 35.5%. That's quite a jump from 28.2. So 35.5% of those polls say they're bullish. That's an 11-week high. Bears percent was lower, 25.8, down from 29.6. And that's actually the lowest bears now since January. So there is creeping optimism in this poll. Nothing excessive as of yet. Also saw bulls percent higher in the Investors Intelligence poll of newsletter writers. Bulls percentage there was higher, 57.8% up from 50%, and the bears percent was lower at 16.7, which is getting quite low. Looking here at the current charts, key level on the spider is at 243.40, which is the 2-month. The first Indication of weakness would be a value area or a bar printed below that 2-month support. Worth looking quickly at the technology sector. XLK really bounced back this month. Just back to the spider here. It's worth mentioning that in the recent Bank of America survey of fund managers, majority of fund managers declared that they were very underweight US equities due to the extreme high valuations as they see it, and very overweight Europe. If we look at this chart here of the S&P, just compare that with recent price action over the last couple of months in the German DAX, the French CAC index, Stoxx 600 and the Euronext 100. You can see that relative to the US, it looks as though the fund managers, at least across this time period, have got it wrong there. Bank of America Fund Manager Survey, again like most sentiment surveys, pretty much a contrarian indicator. UK's FTSE 100 doing pretty well this week though, holding above its important level at 73.46, which is the 12-month controlling price and support. TLT, the T-bond ETF, bonds coming back over the last few days here, as I mentioned in the pre-open, in a strong price location above its 8-month at 121.63 and definitely above the major at 119. The bonds remain in a strong position here. Again from the pre-open, and saying that USO, the oil fund ETF, been in a weak position long term since this point here when it broke below 11.44, the major, and further price action below 10.28 puts it in a weaker price location, and we're below the halfway point off this major low. So oil, certainly this ETF, still in a weak location. Come back to look at gold after we've looked at the dollar and some forex charts. This is the dollar index. I'm talking about this level here at 95.57, which is the 2-year controlling price. Found support here. I said when we break below that level, which we did a few days ago, put the index in a really weak price location, and we've seen it fall pretty swiftly from there. Did say I had a downside target 93.55, just a little lower in here just from distribution targets on the way down. Wouldn't be happy about the long side. If that 2-year remains at 95.57, you'd have to wait for price at least to get back above that level before looking for further strength. 93.55 could be a stalling price. Also looking here at UUP, the bullish dollar index ETF, today printing or just testing below this major value area low at 24.35. Test below long-term value is often where a chart will bounce back. Euro FX chart really strong, pushing out today to its highest level since back over here, August 2015. If you look at price, that higher low in there, right on the major point of control at 113.29, and we're seeing an acceleration higher from there. Plenty of room for Euro FX chart to retrace and still stay in a really strong long-term price location. Pound currently holding above its 5-month support at 129.36, which was briefly tested yesterday, so we're still holding in this really strong price location currently. We see price printing time below 129.36 would indicate short-term weakness for the pound, but currently that's strong. And we looked at this chart last week in last week's video, the Australian dollar, the major and the 4-year down here, and when we broke above there, we've also seen this chart accelerate higher, showing strength against the dollar. So finally we look at gold. This is GLD, the gold ETF, and this is the major level, the major controlling price at 119.84. GLD continues to print below that level, and that level does not migrate. It keeps GLD in a longer term weak price location, so we really want to see something, a higher low above that level would put the chart in a really strong position. Currently for the longer term needs to do that to really convince. And let's go back to last week's ebook. We're looking here at in the top we've got the GLD chart, the gold ETF, and below that we have the commitments of traders data, the old legacy data, which is divided into commercials, speculators and small traders at the bottom. The large speculators are usually the group to go with until they reach an extreme. You can see an example of that over here when we reached an extremely bearish position for the large speculators, and that marked the low. And at the same point, the commercials in the longer term, called the smart money, were more bullish than they'd been for many months, a couple of years at that same point. So these groups, this one to be followed apart from the extremes, this one to be faded usually apart from the extreme. And what we've seen recently is the commercials out on a bullish extreme and the speculators out at a bearish extreme, marking a potential turn higher for gold. Again, we need to see it back above that major point of control, but this is a setup in the commitments legacy data, and what we can use to break that data down even further is the disaggregated commitments of traders data, which divides the open interest out into a further number of groups. This one in the chart here being the money managers at the top, their commitments. At the bottom we've got GLD, and I've actually put through their 102-week moving average. Money manager are the trend followers. I put Bollinger Bands on that data. The money manager's net position is above that central Bollinger Band. In the main, you want to be following that trend. It's marked in blue at the bottom here, especially if that trend concurs with price at the bottom here being above that 102-week moving average. So this point here is a particularly bullish situation on the positive side. Back in early 2013, here, particularly bearish situation. These arrows mark the point where the money managers reached extremes in their position, their net position. Arrows indicating they were overly optimistic, and the general trend being down marked a reversal lower. And right now, the reason I'm showing the chart is there's a possibility that the trend followers are too negative here, with the trend of GLD as defined by the central Bollinger Band being positive. So it'll be interesting to see what the data comes up with at the end of this week. And here also from the disaggregated data is the kind of the opposite of that. We're looking at the producers and merchants at the top, long-term traders, and when their positions reach a real extreme, it's often a go with and a point where the market will reverse. Finally, this is the swap dealers. Notice that the last 3 times that the swap dealers went net long usually preceded the point where GLD or gold reversed higher, and we're looking at a really extreme situation at the moment. So as I said, I'll be interested to see what the commitments data brings this week. Okay, that concludes. Once again, I wish you a good weekend and thank you for watching.